This is the Mobile Home Park Lawyer Podcast with Ferd. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd.
Welcome back, Mobile Home Park Nation. Ferd here again today with another episode of the Mobile Home Park Lawyer Podcast. Today's episode, I'm going to cover kind of syndication-related topics and nuanced areas of syndication beyond just the normal GP, LP structure and PPM. But what's somewhat new trends, the last couple of years and become a little dicey, in particular in the apartment world for some syndicators that haven't done that well. But basically comparing the co-GP syndication model and the fund-to-fund syndication model. So we'll just go kind of high level here. So what's a co-GP model? Well, essentially this is when, two unrelated GPs or general partners or sponsors decide to work together. You got to make sure you're not co-GPing with somebody who's purely trying to raise capital for you. That can get you and them in trouble if they're a quote money finder, unquote. I've had people do this when I've been a syndicator. They'll reach out, hey, I want to help you out. I can raise the money. I got a bunch of doctors that are going to invest. What's my GP split if I bring all the money? It's like, no, we're not going to do that. But there are legitimate co-GP models, and what this can help you do is you can team up and collaborate on skills, on networks. So for fundraising, also on finding deals. If me and two or three other GPs are all looking for deals together, we can perhaps find a gem. We can have access to deal the other guy found. We can perhaps find bigger deals because we now have the bandwidth. Maybe I'm good at financial analysis, you're good at construction management, somebody else is good at day-to-day property management, etc. So some of the pros of the co-GP models, you can find more deals, take on bigger projects, perhaps combine skills. You can also diversify the financial risk. And if it's $100 million deal, maybe I can't get a loan for that. But if there's 10 of us or 3 of us and one of you guys has $100 million net worth, then great, maybe we can all get in on it. So spreads out the risks, the debt, really can supercharge your capital raising power. And just pool everything together. Some of the cons, well, like any partnership, I heard a quote years ago from a banker that says, the only ship that doesn't sail is a partnership. So, that's part of the challenge is who's going to be the decision maker. Is one person slower? Is there disagreement? There's going to be more legal documents you need to go through. You could have friction and could preclude long-term growth. And then if you have a business divorce, well, that's going to be a messy situation. So you got to think about if this makes sense for you. You're going to need significant vetting, probably getting to know each other, very detailed legal documents on some of these complex structures. Another risk or con of the co-GP model is, let's say it's me and John and Susan, and John ends up getting in trouble for embezzlement from his day job or beating his wife or cheating his tax returns or something. Well, now he's my partner, and so it's a reputational risk for me. So you got to worry about that as well. And then also anything if you've ever been on a group project, for something in school, there's that old joke, so to speak, or story of the guy that doesn't do anything and he shows up on the day of the presentation like, hey, I'm part of this team, I want to get this shared grade. So there's risks and disputes on hey, are you pulling your weight or not? I had a few co-GPs a couple of years ago. These are more internal GPs, just partners, than somebody that I found for co-GP purposes. But everything went well most of the time. But every once in a while, other guy wants to work 39 hours a week and I'm working 79 hours a week. Well, it's not that ideal for me. So it's like, hey, man, pull your weight. Well, I'm looking for work-life balance. Okay. Well, so am I. If you would work harder, then I'd get a little more work-life balance. If you got too much work-life balance. So you can have you got to really make sure you got the right fit. So some of the ways you can mitigate some of these risks, one, establish clear communication channels, consistent, open. You want to make sure everybody feels like they got a fair deal because partner fights can be a problem. You don't want partner fights. And you want to have specific, I'd say, define the roles and responsibilities and make sure it's clear. You're in charge of this. You're the one that's going to go to the property this frequently. You're the one that's going to oversee the contract. You're the one that's going to do this. I'm the one that's going to do this. I'm the one to do that, etc. That also helps kind of paper the trail that nobody is purely a money finder. And then you need some sort of, decision-making framework. If it's, three of us and I'm 60 and you're 20 and the other guy's 20, it's probably implied that I'm the decision maker. But at least it's got to be spelled out. If it's equal partners, then it's going to be more clear. And your operating agreement needs things like a buy-sell agreement, or impasses. What happens in that part people can't get along? Is there an appeal right? What's the price of exit? All those other kind of issues. And then again, another way to mitigate the risk is just thorough partner vetting. Um, I've had partners over the years, and my worst partnership was one that I didn't vet hardly at all. I knew the guy. He was a client and seemed like a nice enough guy, was very successful financially. He called me out of the blue and asked me to be his junior partner. And I said, I don't know, what kind of contract, what kind of terms am I going to get? And he said, I'll give you half the commissions. We are doing retail and shopping centers and stuff, and new construction stuff, and rehabs on shopping centers and things like that. He goes, I'll give you half the deal or half the commissions. I'll give you 10% of the deal. You put no money in. And I said, well, I don't know if how do I trust you and all this? And he says, come over here. And he pulls out his checkbook and he writes me $100,000 check right there during the job interview. And he said, this is your signing bonus. Do you trust me? And I shook my hand. And I said, I'm in. Well, little did I know that that 100,000 wasn't going to be worth it. The check did clear, but I didn't do more vetting than that. I was really excited and ambitious to be part of this industry and all that. And uh, didn't think about it. So I'm very diligent today at partner vetting. And now even my junior partners, I have them, they get equity, but it's vested over a certain period of time. They have a written agreement, and it goes both ways. I can't take advantage of them and vice versa. And then also you just want to make sure, again, anything you have is in writing, legally sound, that everybody understands. So overall, the Coach model has a lot of pros, some cons as well. The fund to funds model, I've never done any of my deals. I guess I've had some investors that I think are probably fund to funds people, but didn't really care, so to speak, to me. But a fund to funds, typically, it's somebody who's raising money from individuals or groups to then pool their funds to then invest in somebody else's offering like mine. And they're more passive. They're just like they may come at me and say, hey, I'm investing through my company. Well, I may not know if the company has one investor or 10 or 20 or and if they're passive or active. Now, if I'm doing a syndication, I probably have some obligation to vet if they're accredited investors. Now, I may rely upon the sponsor of the fund of funds is telling me, and they're the one that's responsible for vetting their people, and they're not really selling the same level of security that I am. They're selling an investment into my security, so they should probably be doing their own PPM. To some degree, it's their problem, but it doesn't always happen above board from what I've noticed some of the marketplace. But the benefit of a fund of funds is, somebody can come to me with more money. So the benefit to their end users is, let's say, like I had a fund of my own one time where I said, if you invest 50, 250 or a million, you get a 7 pref, an 8 pref, or a 9 pref. So the guys that put in a million get a better deal. And then there was a better splits too. So say 30, 70, for the big ones, and maybe 40, 60 after the pref for the middle tier, and 50, 50 after the 7 pref people. So if John Smith only has 100 grand, well, he's going to be in the lower tier. But if John can pull together 9 or 10 other people to come up with a million, well, he's added value to them because he's been able to get them a better slice, if you will, for his services, for putting it together. And in theory, what he should be doing is vetting me and doing diligence and underwriting for the benefit of his end consumers. The other pros, for his people is it gives them a better chance to have diversification. So let's say you yourself had $1 million to invest. You can only put it in so many deals. If the deal you want to get in has a 250 minimum and you do 4 of those, you're in 4 deals. But if you take your million and you put 100 with 10 different fund of funds people, or maybe one fund of funds person who's investing in 10 different deals, you can get instant diversification in 10 deals that otherwise you might not have access to. And then there's certainly fund to fund managers that are very sophisticated, top tier. So if you invest through them, you can get access to their elite talent and opportunities that they find. I have a client that actually does this, and he's got a ton of firepower behind him and good reputation, does a lot of vetting, and he's able to negotiate better deals for his end users and hopefully less risky deals. And then also by pooling your funds together, I kind of already implied this, but you can basically get in with lower minimum investment. So like I talked to a guy yesterday actually who I'm going to do a PPM for our law firm, and he said, yeah, our deals we have a minimum 250. Well, like if I wanted to invest with that guy, I probably don't want to invest 250 in my first deal. I don't know him that well. I haven't seen his track record personally, and it's a big chunk of cash. I might instead choose to, hey, let me do just put 50 in there. But if the minimum is 250, I need to go through a fund of funds person. Also, if you want to be truly passive, just going with the fund of fund person is better because it can be better because it's simplified. I just, hey, here's my $1 million. You go put it where you want. People are typically resistant to invest super passively with fund of funds managers, but reality is most of us do this with our financial advisors on our stock portfolio or mutual fund portfolio. So it's an option here. Some of the cons, you're basically you could get hit with double layers of fees. That's an issue. You've lived because the underlying, if I'm a syndicator and you're investing in a fund of funds, you're getting hit with your fund of fund guys, his fees, but he's getting hit by my fees. And then you're super passive, so you have limited control. There's layers of control. The diversification can have a double-edged sword. It's good, but it also can dilute your returns because you're putting 100,000 in 10 mediocre deals, perhaps instead of 250,000 in 4 premium deals. And then you need extra due diligence because there's more layers, more people, less control. If you're investing with a fund of funds person, they have limited control. And you have to ask, why are they doing fund of funds instead of doing their own deals? Maybe it's because they just can't operate. Maybe it's because they don't want to operate. Maybe it's because they can't find the actual off-market deals. So they haven't invested as an LP, and then you're a down the river LP, so to speak. So ultimately, you got to say, do I value the convenience and diversification over hands-on control? Am I comfortable with the fee structures? Do I trust the sponsor to make sound decisions? And then do I trust them to make sound decisions in picking other sponsors who are making sound decisions? So ultimately, you got to decide if you're an investor, is it better to go direct? Can you find deals direct? Is it better to go to fund of funds? And if you're a GP, you have to decide, do I want to raise the money myself, retail investors or family offices or private equity groups, or do I want to not do that approach? I want to have a co-GP or some sort of loose relationship or partnership with the fund of fund sponsor. So lots to think about in the world of investing. This is just high level. Reach out if you got more questions, or I'm sure lots of other resources out there. But until next time, thanks and God bless.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.